Good morning, and welcome to the Energy Prospectus Group webinar hosted by ROK Resources. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Good morning, everybody. Welcome to today's webinar. I'm really excited about ROK Resources. They hosted a luncheon for us a few months ago in Houston. And since then, they've made a lot of progress, including selling a non-core asset package that provided enough cash to pretty much pay off all of their debt. So the company's in really good shape financially, and their summer drilling program is off to a good start. So again, welcome to today's webinar being hosted by ROK Resources, a recent addition to our small cap growth portfolio. ROK Resources is a public company based in Regina, Saskatchewan, that is now poised for strong production growth. They closed two strategic acquisitions, one in March of 2022 and then another one in January of 2023 that pushed their production over 4,000 BOE per day. And then they had a non-core asset sale in April that reduced production by about 800 BOE per day, but generated enough cash flow to pay off most of the company's debt. Their summer drilling program that kicked off in June is off to a great start with 5 successful wells. 3 have already been completed. Joining me today are 3 of the company's founders, Cam Taylor, Bryden Wright, and Jared Lukomsky. I'm probably pronouncing that wrong.
No, you got it right. Well done.
Got it right. Okay. Well, Cam Taylor is the company's chairman and CEO, and prior to co-founding ROK Resources, he was the president of Villanova 4 Oil Corp, Villanova Oil Corp, and Villanova Resources. He is a geoscientist with over 30 years of experience in oil and gas exploration development. He graduated with a BS in geophysics in 1988. And has been working in the Williston Basin, the foothills, deep Devonian, and heavy oil exploration within Canada. Bryden Wright was with him over at the Villanova companies. He has recently been promoted to the company's president and chief operating officer. And prior to co-founding ROK, he was with those Villanova companies. He has 12 years of experience in the Williston Basin, oil exploration and production. The Williston Basin does go up into Canada, by the way. Specifically in southeast Saskatchewan, conventional and unconventional oil plays. He holds a BS in petroleum systems engineering and is a registered professional engineer. Jared is the senior VP of land and business development. He also was with them at the Villanova company, so they've all been together for, I think, about 15 years. Then he was employed by the Connex Credit Union from 2000 to 2007 before going to the Villanova companies, and he managed their accounting over there. So at this point, I'll remind you that during the webinar, if you have a question, please type them into the chat box and we will answer them after the presentation. With that, I will turn it over to Cam Taylor for an introduction and update on ROK Resources. So go ahead, Cam.
Can we just confirm you're seeing the presentation?
Yeah, I am. Yeah, we are.
Great. That's great. Okay. Yeah, thanks for that introduction. And thank you, everybody, for joining us this morning for this opportunity to tell you about our company. We are a junior oil and gas company with a focus on growth. We have been rapidly acquiring assets and beginning that drilling program that was mentioned. Our main focus has always been organic growth, identifying under-drilled properties, doing some strategic acquisitions, but then drilling those properties out and growing production and reserve base. So we're sitting at the end of the divestiture that was mentioned. We popped down to 3,200 BOE a day. We're up at 3,900 BOE a day now with a couple of hundred BOE shut in for a gas plant turnaround. So a little over 4,000. Still still on target to hit our 4,500 BOE a day exit. And obviously with pricing looking very strong now on WTI, we're expecting to do well on the net operating income and cash flow side of things. Another piece of this company is a holding in a fairly exciting lithium project. Within Canada, there's been explosion of lithium brine projects, and we've drilled the two best wells in Canada now down in the southeast corner of the province, right underneath our oil field. And that project is moving forward in partnership with a lithium company. We own 25% of that project. So I just wanted to mention that because we keep treating that as a free option to all of our investors who are invested in ROK, but it is gaining quite a bit of momentum now that we've had a couple of these tests over 200 parts per million on the lithium front. So just to identify what's going on there and why we do speak about the lithium. But primarily, we're a oil and gas production company with a focus specifically in southeast Saskatchewan. Our team has been together for 15 years, working as a group. Number of us have more experience than that prior, but this team has been operating in southeast Saskatchewan for 15 years. Typically building and selling private cos, 2-year cycle time, start with 0, get it up to 1,000 to 2,000 barrels a day, and then sell it to a public company looking to grow. So over that time, we had raised about 154 million of equity and returned about 458 million. Accomplishing that through downturns, including the financial crisis and the 2014 oil price collapse. So, we were able to understand that balance between aggressive growth and financial stability and surviving downturns and taking advantage of them. At the end of the Villanovas, we made this move from private into the public space, accumulated a series of assets through the last 24 months, and that's sort of gotten us to where we are today. Key assets, we initially picked up a block of assets in our core area here for assumption of liabilities. I think we signed that deal the day, if you remember, in the beginning of COVID, there was a day oil was actually traded at minus $39. We signed that deal the day oil was minus $39, and we're able to get it for 0. That 100 barrels a day, we've been drilling on it. It's currently at 400 barrels a day, and a couple more locations coming on here. So very successful acquisition. The next one was Federated Co-op, which we executed in March of 2022, bought that for a $58 million net for 3,000 BOE a day. We've since sold all of the non-core assets for $74 million and retained what is currently about 3,000 BOE a day of production from that. And then recently did a fairly important acquisition plus asset swap where we consolidated a lot of holdings in our core area. We're now the dominant player of facilities and infrastructure in our core area. So feeling like the company's very strong now with that core area having a dominant position, and also our debt being paid down through the sale of those assets. So I think we've been moving the company forward strategically quite rapidly here. We've had this last 6 months to really digest the assets, start to tighten up the operations, bring wells back on, the good operational work that is hard to get done while you're in the middle of buying and selling things. We've been able to sort of get back to our knitting and get those issues dealt with, and feeling really good about where the company's at. Started drilling recently, and I'll let Bryden give an update on some of the results of that.
Yeah, so we just completed the, I guess, phase 1 of our drilling program. We have a 10 well program for the second half of the year. We just finished our first 5 wells. We've taken about a 10-day break with the rig, and we'll be back drilling the second half as of October 1. So our focus with this drilling program has been Southeast Saskatchewan, conventional Mississippian. So there's 2 plays, the Frobisher and the Midale. We drilled 4 wells into the Frobisher and 1 into the Midale. We've had 3 of those wells we've brought on production. The other 2 are, in various stages of completion, equipping tie-in. So far, we have about 35 days of production in the 1 well, and the other 2 are just under 1 month. And the production has come in above our type curves. We're really excited about the results so far. All of these locations are they're either PUDs or probables that we've moved into PDP, or they were unbooked. We actually have 2 of the 5 wells were in areas that had previously been unbooked. So we'll be looking to add reserve barrels there, both on the PDP case as well as upside inventory. So that's been an exciting first phase. And as we move forward into the second phase, we'll actually be drilling the first 2 wells on the recent Whitecap acquisition. So we haven't spent any capital there yet. So we'll be drilling 2 Midale wells right out of the gates on that Whitecap land base, and then followed by most likely 3 conventional Frobisher wells to follow. So there may be additional non-operated wells that we're served notice on over sometime in the fourth quarter. We're having some conversations with some partners on that, so we may see a little bit of an uptick on non-op capital capex spending, but it won't be a meaningful, might be 1, maybe 2 wells. So yeah, as far as the drilling program goes, it's been a good start to it, and look to complete those next 5 wells by late November and have everything on production by year end.
Thanks, Bryden. The quick look at the cap table, 215 million basic shares. The bulk of our dilutives are in a package of publicly traded warrants that were done with our initial raise. The strike price is 25 cents. They have about 18 months term left on them, 113 million of those. The market capitalization, roughly $70 million. Importantly, from our point of view, is the management and board owns 17% of this company. Our philosophy with our private companies was always to have both the management and the board personally invested at a significant level, so that we're in the game in full alignment with our investors. So this really isn't an employment opportunity for us. This is a scenario where we're managing our investment alongside our investors' investment. So we've participated in every raise so far and continue to accumulate stock as we go through the course of this company. Bryden, do you want to just walk through the guidance?
Yes. So our Q3, obviously that's been kind of anchored by this drilling program. We began drilling in late June with the first well, I guess would have came on production early August. So we're looking, I would say, on trend with our previous forecast that you're looking at on the screen here, 3475 BOEs per day. Hopefully we can exceed that as we finish September here, try to get one of these, I guess the 4th out of the 5 wells on production, and keep these other wells running, and so hopefully we can exceed that. Obviously we've had an uptick in oil pricing. This model used an $80 WTI, 250 MCF on gas. So we have had a bit of an uptick. So again, hopeful that we see an improvement on this forecast. And then as we go into Q4, we have an exit target of 4,500 BOEs a day. We're on trend to meet or exceed that. As we sit here today, obviously, still half the drilling program to go. But, we hope to, be in that $40 million of NOI over the course of 23. And, with CapEx in and around that $30 million mark. So, Q4 will be again dominated by a Southeast Saskatchewan drilling program and perhaps one well at Kaybob, one non-operated well at Kaybob. And then again, as I mentioned before, if we end up getting served on some non-op wells, we may, increase that capital marginally there and hopefully increase, our exit rate depending on the timing of those wells. So again, I think, this forecast, hopefully is conservative. Hopefully oil prices continue to trend up and our results continue on trend as they've been. And then we'll, exit at or above our 4,500 BOEs a day.
Thanks, Bryden. Just throw out a core area map here. Southern boundary is North Dakota. Eastern boundary of this map is Manitoba. This is our core operating area. The bulk of the wells that we have drilled and are about to drill are within this area. The upper left-hand side of this map is the Steelman area, where we've seen a lot of activity from Surge and Whitecap, drilling multi-leg horizontals, some very good payout economics for all of us in that area. All the way down across this map is our main hunting ground for Frobisher. What we love about the Frobisher is the quick payouts, and we'll get a chance for Bryden to look at those type curves a little bit. As we kind of move down towards the U.S. border, the sort of the big resource style play is the Midale, where we either go in with multi-leg horizontals or fracked horizontals to exploit a very large oil in place number. But what's nice for us now is we have 5 facilities throughout this area and pipelining both for oil emulsion to our batteries and sales oil, but also for gas capture and sales. So infrastructure wise, most of this drilling program that we've just executed or are about to execute, we're able to plumb into existing infrastructure, which from an economic point of view is a massive benefit for us. Bryden, you want to just talk about the location list, and then we'll go through the type curves on the 2 core plays as well.
Yeah, so our drilling inventory is heavily focused, as Cam said, in Southeast Saskatchewan. Combination of conventional Mississippian as well as unconventional Midale, whereby we frack it. We are seeing some producers drilling these multi-leg wells, and I think reservoir dependent. We're able to do that as well versus fracking and saving capital that way. As far as our location count and our inventory, the bulk of our locations are in the Pinto, Alameda, Oxbow area. And just to frame it, and I'll speak to it on the type curves, these wells range from 1.1 to say 2.2 million per well, depending on the play, depending on if it's fracked or depending on the length of the wellbore. So, when you see Pinto, Alameda, Oxbow, Glenue, and Florence, that's the main, I guess, fairway that we operate in. We've built and sold 3 of the previous 4 companies were right in this fairway. The Whitecap acquisition that we did earlier this year was actually getting back a lot of the lands and the wells that we had drilled in a previous Villanova iteration that kind of had been left untouched since 2018-ish. And so we've now brought that back under our management and are looking to drill some locations and grow that as well. Benson and Steelman, we only have 4 locations booked there currently. We have drilled one of the wells that we drilled in this earlier program. One of the successful wells was there. So we will be, hopefully booking additional locations and growing that area. Workman Gainsborough, we haven't spent much capital there. And then Kaybob is the Northwest Alberta, Cardium, Montney, Gething. There's about 10 different horizons to chase there, and it's a little bit more price dependent, a lot gassier, The bulk of our production in Kaybob is gas, about 75 to 80% is gas, versus in Saskatchewan, it's more 75 to 85% oil. So as far as the locations, we have 115 booked on this slide. We do have additional locations. These are more of the core areas. We have, we're looking to, we have, with the success of these wells, identified additional drilling locations, and, we'll be moving to, our year-end reserve report to, I guess, solidify those in both the reserve report and see an updated deck in the new year with our location count increasing. Go to the next slide.
Yeah,
So, when I spoke to the two, I guess, primary targets in Southeast Saskatchewan, the Frobisher would be the most economic. It's one of the top 5 plays as identified by Peters. Peters & Co. It's a conventional high IP play that we've been chasing for the last 15 years. A little bit more geologically complex than say a resource style play like the Bakken, even the Midale in certain respects. So it definitely takes the knowledge base of a solid G&G team, and as you can see from just your recycle ratios, your payouts at $80 and up, you're seeing sub 1 year payouts. We're probably in the 6 to 7 month payout at current pricing on some of these locations. And as you look at the type curve, we use a forecast type curve that's about 10 to 15% below our reserves curve. We have drilled a lot of wells that have exceeded that significantly over the years. But again, it is complex, and you always have a few misses, but the hits definitely make up for those misses. So this is the focus of ours. And then in the Midale, so this is a fracked Midale model. So you see a DC cost of 1.9 million. So you go in, you drill a mile-long well, put about 30 stages in it, and we've drilled a lot of these in past iterations, and that we've had a lot of success here as well. A little bit higher capital cost. Not maybe quite as high as an IP rate in certain areas, but you have a longer EUR and the additional water flood upside as well. So if you couple the Frobisher and the Midale, it's a nice brother sister to have in the family of assets, because you have the high IP, high netback, quick payout Frobishers, and then you have this kind of bigger EUR, longer life, longer reserve life Midale.
Thanks, Brad. Another important aspect of this company's current position is something that we're really happy with right now, is that out the other end of our acquisition process and divesting of our non-operated, non-core, we've been able to pay back our term loan. So in May of this year, we repaid the term loan. It's resulting in very minimal monthly outflows on interest. We were down to a net debt of a couple of $1 million, and gradually been building that back up as we drill and tie in these wells. But very strong balance sheet. Our cost of capital on our revolver is back into a great cost of capital, probably above 8% now with the interest rate rising lately, but still a very low debt level for the amount of production and cash flow that we have. So a very strong balance sheet for the company. We understand that we're a small company, really not getting large multiples right now. As we clean up that balance sheet, we're going to be showing some incredible growth from 3,200 to 4,500 BOE a day for the year. I think as that track record and awareness of the market gets out, we would hope to move up a little bit in our market recognition and our multiple. We do still have hedging contracts in place, given that we have bank debt. We have a program of hedging out about 12 months, typically on 75% of PDP value. And as we all know, the backwardation in the strip is, creates a lower price 12 months out. But just for peace of mind with respect to the debt and the capital program, that 12-month hedging program is something that we will maintain. Just a quick overview of this lithium project, because it's taking on quite a bit of importance now in terms of our potential for the coming 12 months. The position that we own, 25% of this asset, was created because we brought in financial partners to develop this asset. I had them pay the initial cost of land acquisition and testing. So this is something that as a company, we only have $1.2 million invested in, although we have a lot of sweat equity in this and continue to be the operating partner of the property. Because this area sits right under our oil field, this is a fairly easy area for us to drill wells and do brine lifting, etc. We've come in and tested 2 wells in the Mansur area and 2 wells in the Mansur area that tested up to 140 milligrams per liter, and then have successfully drilled and tested 2 wells in the Viewfield area. Our highest zone there is at 259, but we've been able to flow the entire package on an extended flow test for with 204 parts per million or milligrams per liter. The competitors in the Canadian basin typically are sitting at about 75, 80, typically with deeper drill targets. Our belief is that this is actually, it certainly is by far the highest concentrations of lithium tested anywhere in Canada, but the comparative for the economic potential would be similar to the Smackover. The Smackover's got higher concentrations, although it's also deeper and has its own issues with respect to reservoir and contaminants. So we think that the 2 best brine projects in North America right now from an oil field brine, buried reservoirs like this, is this area within Southeast Saskatchewan and the Smackover. We think those are the two top plays that the industry is going to put their money into. We have a large acreage position at Viewfield. We've finished a resource evaluation. We're probably 3 or 4 weeks away from releasing our PEA on this to provide the economic assessment and how those reserves translate into dollars. But the great thing about this play is the resource density. There's anywhere from 8 to 20,000 tons of lithium per square mile in this brine deposit. And that provides the potential for great economics, a very small footprint, and limits the need for piping brines long distances, when we get to the development stage. So a very high quality resource. We're busy doing pilot studies as we speak and moving ourselves towards the development of this asset. So exciting for us right now. So I think before we get to the questions, just some catalysts that we'd like you to consider when you're thinking about ROK Resources as an investment. We've very deliberately gone into an area we know well and accumulated a large asset base, a lot of good infrastructure, good light oil production, and something that because of the high netbacks on this oil in this area, very strong free cash flow generation. We've been at this for a long time as a team and building and selling companies in this area. We know these assets well. We have our eyes on other assets that we're constantly evaluating and bringing in to add to our core area. And we have a long location list to drill in this area, both in terms of our reserve life index, but also our opportunity to add to that reserve report. So this drilling program is really the key, and we've seen great results out of the first 5 wells, feeling really good about the next 5, and we have a package of wells on our new asset that we picked up that we're licensing and getting ready for drilling in maybe at the very end of Q4 and certainly into Q1 of 2024. So good balance sheet, great growth opportunities. You know, we expect to, from May to end of year, we expect to get close to 50% growth on production. I don't think we'll achieve that all the time, but hopefully it demonstrates our ability to create organic growth. So good balance sheet, great opportunities, history of organic growth. I think it's a good package, and we'll just sort of keep improving it as we go. So that's the story of ROK.
All right, guys, you ready for questions?
Yeah, for sure.
All right. Hey, good job. And I want to remind our EPG members, this is why you pay me the big bucks, is to find stories like this. Because I think this is fantastic. I think the fact that you guys did those 2 big acquisitions, you sold what, not even 25% of your production, and that those proceeds paid off all that debt. That's incredible. I mean, what you've accomplished in the last 2 years and the running room that you've got now with a strong balance sheet, it's incredible. I can tell you, I haven't seen many small cap stories this good. So we'll just go from there. But I've got several questions before I get into the ones that you guys have typed in to the chat box that I put together. So let me ask you this. When all 5 of these phase 1, those first 5 wells, when they're all completed, they should be completed by the end of September, you think?
Yeah, I think the first one, we're just doing some conversions on an injection on a water flood at Benson. So we're just doing that. The well's ready to be on pump. It's all equipped. So I would say that should be on in the next few days. And then the final 5th well in the Midale should be on by month end. So let's say by October 1, we should have those pumping.
So early in October, you're going to be what, to like 4,200 BOE a day, something like that?
Yeah, I think, you know, that's our hope and our expectation.
Yeah.
Obviously, until you get these wells on pump, there's no guarantee. You know, as far as the reservoir, it looked really good in our last well in the Midale, and you know, the gas in Kaybob, we're hopeful that that'll be back on about the 2nd week of October. So, you know, fingers crossed we don't have much downtime on that non-operated production in Kaybob. So, you know, if all things go well, yeah, I think, you know, that's probably a good estimate, Dan.
Yeah. Okay, good. So right now, is your operating cash flow, like, will 4th quarter operating cash flow cover your drilling and completion cost?
Yes. Yeah, we're
So you're living within cash flow.
Expecting to have free cash flow in the 4th quarter. The 3rd quarter, we definitely drilled a lot more, spent a little bit more capital with some facility work and such. But yeah, and then but we pre-purchased a lot of our pipe, which is one thing that we did last year, which is, you know, helping our capital costs on these wells as well, which is about $200,000 per well. So but yeah, to answer your question, the expectation is, especially at current pricing, to have a little bit of free cash flow coming out of Q4.
Are these they're all horizontal wells, or are they these multiple leg?
They're all horizontal. Yeah.
Are you drilling like Surge, I know, is having good success in there with those multi-leg wells?
Yeah, in fact, we just drilled a 3-leg well. That was a decision that Cam and our geo team made. And again, it's very reservoir dependent, but it was a decision to not frack the well. We accessed 3 distinct layers within this formation, and all 3 are prospective. And so yeah, it's exciting to get that thing on production, because we haven't done that really in a long time. And seeing Vermilion and Surge, you know, kind of lead the way with going back into these multi-leg, different orientation type wells is kind of cool to see. So
so what do you do? You just drill, you do a vertical well and you case that, and at the bottom of the casing, you just drill out in different directions and leave that open hole. You don't case those.
That's exactly right. Yeah,
you don't case the legs at all.
You don't. The only time you would case the legs is if you're going to put a hydraulic fracture in there. And, in that instant, you cement a liner in that open hole, and then you
Mhm.
frack it through the frack ports. But on these ones, it's just open hole from your ICP.
So you
point.
got pretty good porosity in these zones, right? You don't need a frac.
Correct. Yeah.
Okay, good.
Yeah, the reason for the frac was to connect all three zones with the single wellbore and
Okay,
fracture connect them. But in doing so, you also access some high water saturation rock and you get higher water cuts. This well that we just drilled, we accessed all three of those zones and we saved about $500,000 from what the cost of a fracked
Mhm.
well would be. And so, our expectation is we should be able to recover the same amount of oil out of that well with $500,000 less into it. So if all goes well, we'll see that technique being used a little more in this area.
Yeah, I tell you, it's amazing today when I see these wells pay out in 6 to 8 months. When I worked for Hess for 18 years, heck, if we had wells pay out in 3 years, we were happy. A different world, man, on this stuff.
Yeah.
Well, okay, the next 5 wells, the wells that you're going to drill before the end of the year, you're going to kick that off what, mid-October?
First week of October.
Okay, and then when do you start completing those wells?
Yeah, so basically what we do is, we'll have one rig go, begin that 5-well program, and we just go, well to well. And in the meantime, then you have a service rig essentially chasing those wells, following behind and completing them. And then depending on the flow line length and the tie-in and how we're, equipping those wells, then that would follow. So typically we would have from rig release of the drilling rig to, assuming these aren't fracked wells, so let's just say conventional wells, we would have them, on production typically in about 2 to 3 weeks, at the most.
Okay. So mid-November, you could have several of these wells on.
Correct. Yeah. Yeah.
Okay.
That's our expectation.
Should they all be complete? They all should be completed by the end of November.
Yes. Yeah. Well, I shouldn't say, I guess the last maybe well or two would be tight, but definitely by the start of December. Yeah. First week or two of December, and
okay,
try and get 20 days of the last well on before year end.
So you're just running one drilling rig now?
Correct. Yeah.
One drilling. Okay. Now, with oil at $90, when do you think the next batch, are you going to have that rig drilling still in the first quarter of next year?
Yeah, that's the intention. Yeah, absolutely.
So now you just be kind of like you do 5, then wait, take a rest, then do another 5, whatever. Okay.
Yeah, and we haven't finalized our budget. That'll come out in November for 2024. I think, it's obviously going to be contingent on this next set of 5. We are able to do follow-up locations on the wells we've just completed drilling. But as we move into 24, that'll get firmed up. I expect us to drill a number of wells in these areas and maybe, depending on oil and gas pricing, deploy some capital in Kaybob next year as well.
Okay. Can you go back to that slide that shows how many drilling locations you have? Isn't it like 100 something?
Yeah. And while we're sliding back there, I think
150.
it's reasonable to expect, we will revisit this capital budget and pacing. If we're sitting in November when we take a look at our forward budget and oil prices remain as strong as they are and our free cash flow remains as strong, we would very likely move to a scenario where we kept a rig just busy steadily. That's
great.
That's typically how we operated in the past. One rig, one set of services, just constant throughout the year. But we needed to get to that point where we're paying for it from cash flow and we have free cash flow. That's sort of the target that would be great to get to.
Yeah.
So what's the drilling time on the well per well?
Yeah, I was just going to say, to frame what that means, that would be about, say, 20 wells in a year if we had to drilling rig steady. Perhaps 25. We have about a 2-month to 3-month breakup period, spring breakup period, where you can't really mobilize equipment. Snow's melting, and you have all of our dirt roads and our grid roads and our lease roads are just inaccessible. So that takes out roughly mid-March to mid-May, if not a little bit longer of every year. So, we could drill 2 wells to 2.5 to 3 wells, depending on which wells we're drilling per month in those remaining months. So anywhere from 8 to 13 days, Dan, on a well.
Yeah, good. That's good. Well, yeah, I work for Hess, so we pretty much shut down everything. We do winter drilling maybe through February or something, and then stop for like you guys are doing, like 3 months, or we shut down everything. Just too expensive. I mean, it's just
Right.
crazy.
Same thing. Yeah.
Yeah, you're wasting a lot of money trying to pull rigs around in the mud. Anyway,
Exactly.
okay, I said okay. Oh, can you give me on the third quarter, what's the split on your liquids between crude oil and NGLs?
Yeah, so currently we're doing about, so I think I released 65% liquids.
Yeah.
And so let me just take a peek at, you go back to that first slide there, Jared, where we're 30. See, this is actually outdated. We're 37, we're 3,900.
Yeah.
Just let me do
Right.
a quick bit of math. Out of that 3,900, we're doing roughly 400 barrels of liquids. And about, what would that put us at? Just check one thing quick. Don't want to give you the wrong numbers.
Yeah, 400 barrels of NGLs, right?
Yeah, about 400 barrels of NGLs and, say 1,900-ish barrels of
That's exactly what
yeah,
that was my guess.
of oil.
That's what I just updated my forecast model to. So,
Yeah.
okay, so going forward, I'm saying for 2024, my production mix, 55% oil, 12% NGLs, and 33% natural gas. Is that
Yeah,
reasonable?
that's absolutely reasonable. I think the only thing that could flip that a little bit is if we saw a big rise in gas prices and we chose to drill a Montney well, say in late 24.
Yeah.
Which is always an option. And those are anywhere from 800 to 1,000 BOEs a day, 80% gas. But right now our expectation is to focus on Saskatchewan light oil, and then anything in Kaybob is a little bit more price contingent.
Yeah, I know if it's like talking to in-play and stuff. What's the natural gas price up there right now? Canadian.
I think we're in that 3 to 350 range, I think.
Yeah, I think it's
yeah,
getting a little bit better, but
yeah, it's definitely getting a little bit better as we move to fall.
well, I'll send you a real nice roundtable with some of the 3 smartest people on the commodities market that I know.
Yeah.
And they are super bullish on natural gas for a year from now. I mean,
yeah, we've had that kind of same, we've read the same reports. I think we've talked to some of the same people, perhaps, Dan, because that's our view as well.
yeah, it's I tell you, when for one thing, I tell you, some of these areas like the Marcellus Appalachia area, they're now pipeline constrained. They can't really increase production all that much. So when these LNG facilities start coming online the middle of next year, it's gonna be very interesting. If we have if we just have a normal winter, they believe that by third quarter next year, the U.S. market is going to be undersupplied, and that gas prices will start moving toward the international prices as we gain more and more LNG export capacity. We'll see, but I mean, it's interesting times, that's for darn sure. Let me see here. Oh, go back to your cap table. I want to ask you about the warrant situation, because I got several emails from our guys worried about that. So these warrants are publicly traded, correct?
That's right.
So instead of doing like a stock buyback, if you have free cash flow, couldn't you go out and start buying these warrants just to get them off the market?
Yeah, we can. We're currently restricted with our line of credit that we've been utilizing for the drilling. That line and that bank is not friendly towards share buybacks, warrant buybacks. So,
yep.
This is one of we have an interest expense with them, but we also have an opportunity expense with them. And we have a review of that in November. And it's one of the things that, is on our plate, having that conversation. We missed a great opportunity in June, July for that. Yeah, it's something we talk about, but currently not able to do it.
Well,
Dan, I think the
go,
one
go
thing that your members and people looking at our company should know is that those warrants, the bulk of them are 25-cent warrants that expire in March of 2025.
Yeah.
So, obviously they're free trading, but at that moment, that would bring proceeds of about $28 million into the company.
Yeah, I know.
So,
And that, if that's what people, they seem to forget that, they look at the dilution,
yeah,
but I say, look at it this way. You get $28 million. Let's say all that and all the, non-public and all those warrants are exercised. You get $28 million cash in the front door. Well, how many new wells could you drill with that?
Yeah.
Yeah.
Right. That funds another 10 well drilling program.
Yeah.
And
Another
what
20 well drilling program.
Yeah, 20 well drilling. And then look at the cash flow and stuff that adds. So when you look at warrants, or you look at any kind of convertible security or something else, I see people say, well, yeah, but that added 100 million shares. Well, but what did it do to the asset side of the balance sheet?
Yeah.
What does it do to the reserve growth and production growth of the company? You can't just look at one side of a convertible security and just look at the dilution side. I look at it as a positive. That's a positive for a small cap, because that's free capital, non-interest bearing money coming into the company. I just think you need to look at it differently when you're at that shape.
And along that line, when you plan your capital strategy, as we get closer to that date and we understand what our production is, and we've got some hedges, and we understand what our value looks like, we can get out ahead of that 28 million coming in and use our line of credit. Q4 and Q1 leading into that is an opportunity for us to really top our production, reserve report, and growth, knowing that we have a source of capital that'll zero that debt. So, it isn't just that date. It also creates, as you get closer to it, some strategic potential with respect to how you manage your balance sheet as well.
Yeah. I mean, I run the forecast for 2025 on the fully diluted number. And I mean, this still looks like a 80 cent to $1 a share stock value then, minimum. I mean, anyway, my valuation not there. So let's talk about the warrant. Okay, let's talk about the lithium project for a minute. When do you expect that? What's the timeline? When if you guys were going to operate this, not sell it or anything, you're going to operate it. When could this start generating revenue? And how could this be monetized?
Yeah. So here's what our plans are. And these aren't executed yet. So these are all I'm just going to call this the wish list that we're working towards. Yeah. First, we want to solidify that management control of the project. Secondly, we would like to, instead of having a 25% interest in a private holdco that holds the asset, we'd like to have a 25% interest in the public lithium company that holds the asset. That's all it has. And that creates two advantages for us. It creates a mark-to-market daily price discovery on what that is, and helps our shareholders value. So let's say we own 25% of that. It's an easier calculation on what is the value of this sitting inside ROK. The second thing is it's a liquid asset, and it gives us various options down the road. Once we've created value, it gives us the option to sell some of it or all of it. It gives us the option to dividend those shares out to our shareholders. None of that I expect to happen in the next 6 months, but it creates better liquidity, better mark-to-market visibility. So that's a goal, short-term goal. Secondly, we're very active in this preliminary economic assessment for strategic reasons is probably coming out late October. But that converts how many tons to how many dollars for investors. So getting that out is important. The The large volume pilot tests, one of them that'll start the week after next, and the other one that'll start in December, are providing the real fine tuning of the technical data so that we have feasibility study, quality, cap cost, op cost. All of that we think will be done by March, April, and including some downstream arrangements. So we feel that by March, April, we're in a position where we have very high quality numbers, and that puts that project in a position to sign a licensing agreement and a purchase order on an initial facility. And I think from that point forward, there's sort of a 18-month construction time plus a commissioning time. You're still into a 24-month cycle prior to cash flow. And that's the reality of building one of these facilities and commissioning it. And that's what the timeline is. So, I think we're 2.5 years away from being able to say we just made that much EBITDA last month. So it's a long way out, but the scale of the project is massive, and the scale of it's hundreds of millions of dollars of EBITDA that streams off of these assets. But we have a lot of steps to do to get there. And, our goal, we believe we're sitting on the best lithium density in Canada by far. Also one of the best projects within North America from that point of view. We already know that our permitting cycle is more in line with the oil and gas. So we believe that by March, April, all of these things will be sort of resolved on a silver platter for the lithium project to go out, look for financing, sign POs, and move forward. So that's the wish list.
Yeah, but we follow Lithium Bank and E3, and then also Standard Lithium, which is moving forward with these projects in Arkansas and East Texas that are big.
Yeah.
And like you said, the numbers are really big on these projects, the volumes that they hope. So somebody's really just got to prove it. So I think the timeline, I don't, for you guys on the call, E3, which has done a webinar for, I'm trying to get them to come back and do another webinar. They've got a pretty big pilot project going, a pretty good scaled up one that could really prove this the direct lithium extraction DLE process. So once these other public companies start really proving this up and start getting more attention, it's just going to bring attention. Now you're talking about taking Hub City Lithium public. Is that what you're talking about doing?
No, the Hub City that owns all these assets is owned 25% by us, 75% by a publicly traded company called EMP. The only asset in EMP is this asset. We're the operational management. Our goal is to consolidate that so that instead of it being a story of ROK 25, EMP 75, we restructure the entire lithium asset into
the public. Okay.
Yeah, and we would own 25% of that and provide the operational management of that. And so that's the goal there. The E3 Metals Corp's interesting because they just announced a week or two ago. There's sort of 3 big players down here in this best in Canada area of Prairie Lithium.
Mm-hmm.
Ourselves, and right in between us was a block that sold in 2021. We didn't know the owner of it. Last week or the week before, E3 announced that it's them. They had bought it in 2021, and so they're the third landowner in this fairway. And I personally strongly believe that the economics of this trend will drive their commercialization dollars to that part of their portfolio, because they'll be dealing with 150 to 200 parts per million lithium instead of 75 up on their core project. And importantly, this area has no H2S or oil contamination, so there's about a 20% CapEx OpEx that disappears off of the off of the project when you're not dealing with H2S and oil field contamination.
Yeah. Yeah.
Yeah.
Well, I mean, I think this is probably a big deal for the province, right? Saskatchewan.
Yeah.
I mean, these things could turn into something big.
Yeah, no, they're even if we just isolate it, if we say none of the 100 or less projects get any money into them, this area down here that we're involved in, even if you take a conservative mapping of it, it's gonna need billions and billions of dollars, and it's gonna generate billions of dollars of EBITDA. So yeah, it's a big resource. I think there's a lot of error bar in predicting what the supply demand looks like going forward through the life of these projects. But for a province like ours, definitely this becomes we have a massive oil industry, we have a massive potash industry. One of the reasons this lithium is here is that this part of Saskatchewan was the world's biggest salar essentially, and it ended up for that reason we had all the potash evaporated out, and that's why we have all those mines.
Hmm.
And the same reason these lithium concentrations are so high. So we just have the equivalent of a South American or a U.S. salar buried down there, and that's why these concentrations are so high. But it will be a big part of the Saskatchewan economy by the time it's done.
Yeah. Okay. Well, Cliff just posted, and I know he owns some of your stock. So I only know of one lithium from brine effort that has been successful commercially. I believe it was in Peru a few years ago. What is the R&D? What in the R&D says this can be successful in the future? Well, the high concentration of lithium, right? Parts per million. And what has changed? Technology. This technology has been around for 50 years, or what's new? I don't think the DLE's been around for 50 years.
No, not at all.
It's brand new.
The
Yeah.
the chemistry, like this particular tech has been used for other things for a long time, but actually using it to directly pull lithium out of a brine is brand new. There's 20 pilot studies in operation all over the place, but it's brand new in terms of large scale commercialization. And
Yeah.
I think really 2024 is the year that, as you mentioned, companies like Standard Lithium, E3,
Yeah.
we're going to see that scaled up, first commercial projects. So yeah, it's a lot of companies have spent a lot of money over the last 5 years. Koch Industries, um, there's some big players have been dumping a lot of money into moving this technology forward, and I think 2024 is when it's going to emerge. So
Yeah, I had looked at Standard Lithium like 3 or 4 years ago and wasn't that excited. And then, last year when they teamed up with Koch Industries, because when I was at Hess, everything we did with Koch Industries, we had several JVs with Koch Industry, and they beat the hell out of everything. They would
yeah,
not invest. They would not put hundreds of millions of dollars into a project unless they absolutely believed it to be successful.
yeah,
So,
I think that's a really important test for investors in my
yeah,
mind as well. You see, Koch Industries is actually one of the potential suppliers for, building our facility, and they have a lot of people on this, and they have had for a long time.
yeah.
To see them dump 100 million of their capital into a resource project, and not far away to see Exxon having gone through the exact same analysis and dumping 100 million in. These companies aren't doing this without a lot of homework, and
Yeah, yeah, I know.
they're
They're
laying
not.
big bets down.
Yeah, when you're making these kind of bets, you're definitely putting,
Mhm.
that's kind of stuff. Anyway, uh, let's see. I think okay, on your hedge table, you have not added any more hedges than what were on that table.
No,
Okay,
no,
good.
we roll forward as per our banking agreement. We roll forward sort of a month at a time.
Yeah,
And our intent with the bank, because our balance sheet is cleaned up a lot now and our production cash flows up, our negotiation with the bank will be to probably stay with a very aggressive hedge for 6 months, but potentially reduce the 6 to 12 month down a little bit, just because the backwardation is so heavy. So unless we need the protection, we might lighten up WTI hedge a little bit in months.
you know, maybe go to collars. We have a relationship with Aegis. They're a consulting firm down here that does a lot of work with big companies on setting up their hedging programs. And you know, they're saying you can get some pretty good collars now, you know, with maybe a $70 floor and you know, a ceiling of 110 or something. So you got enough downside protection there, but you still keep a lot of that upside. I'd rather see you do that.
Yeah, we agree.
Okay.
Yeah, Dan, and the one thing I just wanted to mention too, if you look at this slide, we're at about 1,350 barrels of oil hedged at, you know, in that $80 range. So you know, a little bit lower than where we are today, but now we're about 800 barrels a day above that of unhedged production. So basically all we've brought on plus an additional, say, 300 barrels a day is unhedged.
Yeah, and the oil today is selling in Canadian dollars like $120 a barrel, I think. Yeah.
Yeah.
That's right.
So it's
right.
looking good. Let me I'll get to all the questions that they posted. Okay. Is the outlook for Q3 in 2023 going up due to the new wells? I would say I'll answer that for you. Yes.
Yeah, I think I spoke to that on the slide. Like, you know, we're hopeful that we beat that production number and you know, our NOI over the last, at least in September, we've seen pricing come up dramatically. So that's the hope, correct?
Well, okay, if you go you know, do like a 15 well program or something next year, I think I'm using 5,500 BOE per day for the full year average for next year. That'd be reasonable.
I think, you know, depending on declines on some of these wells, you know, it might be more like 20 wells, I'd say, to hit that. I think, you know, a lot of these wells, you'll see, say, a 50% decline in year one, and then it'll, you know, come off, or sorry, then it'll start to flatten
Level out.
out into year three. But you know, if we have a rig going steady, if oil prices remain strong, I'd say more of probably 20 wells will be more realistic.
Okay, cool. Somebody asked, is the goal to sell the larger company, or if so, what stage or timeline are you looking at? What production level would you want to get up to? And first of all, you just want to get a reasonable valuation, because I think right now in some of these junior companies, they're trading. I mean, you're trading at what I think are incredibly low multiples. So I'll let you guys answer that. But what's a long-term strategy to sell the whole company, or what?
Yeah,
I think
I'll answer this, and then Cam, you can chime in. I just wanted to, the one thing I think is our focus right now is growing our PDP base. And so when we did these transactions earlier this year and sold Weyburn, the Weyburn unit, we took off a big chunk of PDP, and the decision was let's deleverage, let's reduce our debt. But the trade-off was reducing our PDP reserves. And so the focus of this year, of the second half of this year, has been primarily to replace those PDP barrels. You know, companies, rightly or wrongly, in this, you know, in 2023 are trading based on PDP. And, you know, I think in April, our PDP was around that 28 to 30 cents a share. And so, you know, we've been focusing on that. That's the primary focus, I think, as we move into 24, you know, continue to do that. And then, you know, as far as strategic sales of assets or corporately, you know, that's always, you know, I think it's no surprise if that happens. I think we've built and sold companies in the past, and we've never, you know, I think that's pretty obvious to shareholders and to people that look at the deck. So I think that's the ultimate goal. You know, as far as timing goes, I think when the asset's right, when we've built it up to a point that, you know, there's some good podium value there for a buyer, and there's a strategic reason to do so, I think that will be the ultimate fate of ROK. But yeah, as far as timing, it's pretty tough to give a firm timeline at this point.
Yeah.
Cam, I don't know.
Yeah, I would say, going back to the fact that we own 17% of the company, as owners, our eye is basically only on our IRR and on what is the potential. So if we get to a point where we get offered 2 times cash flow and the company's healthy and spitting out cash, that's a clear no. The multiples that we see today, the answer is a clear no. We're not selling at those multiples.
right,
We'll cash flow and we'll either buy shares back or send dividends out. We're happy owners. We're not selling for 2 times cash flow. But in the past, when we've seen multiple expansions, seen aggressive buyers, that are maybe trading at 6 or 7 and they're offering us 5 times, then you really have to sit down and go, okay, would I rather put that in my pocket now, or do I think I can do better? So we're owners of this stock, and we'll just take a look at those opportunities and make decisions on that basis. It won't be about a certain number of barrels or any other. It'll really just be, what does this look like? What are our rates of return, time adjusted, and do we think it's a good price or not?
Yeah,
That'll
I mean,
be the
why sell something
decision.
way below PV10 value? Or I mean, I don't.
Yeah.
Why sell below your P1 reserves at PV10 value? I mean, I talked to Don Simmons at Hemisphere. I've talked to Doug over at In Play. The same thing. They're going, we're selling our stocks trading at less than 1 times our PDP. I mean, it's crazy.
No, it's not a time to sell
Yeah,
assets right
not now.
now.
Until the world gets more confidence that oil is going to be around for longer.
Yeah.
We're not all going to be driving electric vehicles in 2 years or something. So it's going to be around, and then I'll go. Another question here. So what's a possibility of being bought? I think he's talking about your lithium project being bought out. And to access the brine, have you looked at E3? Yes, I think you have. I think we mentioned that, right?
Yeah, we have a lot of things happening very quickly here. I think we're gonna have a project on a silver platter, March, April, that's gonna be ready to pull the trigger on. I can't tell you what happens with other players and the available capital out there, but our goal here is this thing's sitting the way it's currently trading. Our project, maybe it's worth 2 or 3 cents a share to us. We firmly believe that there's a massive multiple of that available as we move this through to maturity. Unlike, say, Prairie Lithium that went to Arizona Lithium or E3, we've spent no money in trying to invent DLE tech. We've been waiting for suppliers of that, like Koch Industries, for example, to be there to deliver it. And that time has come. And so, I think you're going to see us move this. The scale of our resource is going to be competitive with any of the projects, and nobody in the market other than the players in the market knows about it. So, our job is to get that out there. And obviously, once that's there at that scale, there's all kinds of different opportunities for us to optimize value. But we have a different job to do over the next 6 months. Get it into the market, make them understand it, move it forward until it's ready for that, pulling the trigger on that project.
What is your current CapEx requirements going forward on this project, like through next year?
So EMP as a company will have all the money internalized inside of it, to drill all the wells, do all the pilots, everything like that. The real big dollar amount comes when you go to build that first DLE unit, and that'll require a big financing. And that's one of the reasons it's important for us to separate that into lithium only companies. So there's no confusion that we're not pulling ROK's oil field cash flow out to build DLE units. We want to get this separated so people can look at those 2 assets separately.
And that would also put the debt in that other company, right? The build out debt would go into that other company.
Yeah. All things financial will be in that other company, and it can be evaluated as a standalone lithium project, including all of its financial parameters.
Right.
ROK will just own a big block of shares, and then we'll make some decisions about how to monetize that and get that value into the hands of our shareholders.
Yeah, and I think that's a great plan, because a lot of times when you have companies that mix like vastly different kinds of businesses under one public company, it makes it very difficult to evaluate that company.
Yes.
Especially when you're talking mining that has a long-term timeline, and then you're talking, your wells, like you drill 5 wells to get them online, and bam, they pay out in 6 months. I mean, it's a totally different kind of business.
Yeah, I absolutely agree. It's got to be separate. I personally believe that our asset has a very similar, probably a bit better, but a very similar value to the E3 Metals Corp resource asset.
Good. Yeah.
They're like a $300 million market cap company. This asset is currently 30 some million dollar market cap company. So the important thing for us is to capture that growth as the market looks at this, understands it, and pays for it. So, once we've achieved that, then we want this in the hands of our shareholders one way or another. Either we sell our interest and bring a bunch of cash into ROK, or we dividend that out. But job one is to realize that potential value over the next 6 months.
Okay, we're getting past the time here, but I want to a few more of these questions. Henry asks, the upcoming 5 wells, are they vertical or horizontal? I think you said they're all going to be horizontal, and maybe one of them or 2 of them a multi-leg.
Yeah, we don't have any verticals planned. Typically, we're typically only drilling verticals for disposal wells or exploration.
Okay.
First well into a play, and then we'll go horizontal from there. And then as far as the multi-leg wells, we'll drill both, multi-leg in the Frobisher. That's kind of always been done. You either drill a single or a dual leg typically in the Frobisher. There's multi zones again within that formation. So Frobisher is 1 or 2 leg, and then the Midale we're actually going to drill and frack 2 wells. So we don't have any multi-leg wells planned in the Midale currently.
Okay, and what are your type curve IP30s on these wells?
So the type curves we use are about 110 barrel a day IP30s, and that's the forecast type curves. And the reserves, they vary from 120 to 140 barrels a day IP30. And we're speaking to the recent program, we're seeing an average about 30-35% in excess of that on our IP30s. So
Okay.
so far we're exceeding that, and we expect to continue that with the next program.
Yeah, but again, remind everybody, these wells at current prices, they're paying out 6 months just based on the type curve.
Yeah,
So
like that's based on the type curve, right? So what you're looking at there is a 7-month payout at $90 oil based on that 110 IP30. So
yeah, okay. Somebody posted here, why will we post this recording? Yes, we do. We all of our webinars are recorded. I mean, I think we have like 50 plus people on the call today, but we have a membership about 450 globally, and so the recorded webinar will go out. That link will go out this afternoon to our entire group. Then it's a private YouTube for 2 or 3 weeks. We also send the link to the company, and they can distribute the link to whoever they wish. And then it goes public. And a lot of our webinars have now been viewed by well over 1,000 people. So it gets a lot of exposure for the company. And this is a great story. So I think it's going to draw a lot of new shareholders in it. Then somebody says you buy ROK for the energy part, and lithium is the icing on the cake. Is that right? I think we have established that.
Yeah, we always talk about it. Currently it's a free option for our shareholders. It's a perfect way to describe it. It's the icing on the cake. We'll turn it into a separate cake later, but right now it's the icing on the cake.
Okay. Hey, and in addition to posting the webinar link and sending it out on our website, I will update my forecast model based on what I heard today. The company that will be reposted to the EPG website. You can download an Excel spreadsheet. And the out years, I put the fully diluted share count so you can see what that looks like. But the numbers are going to be very strong. Operating cash flow at $90 oil is going to more than cover a 20-well drilling program for next year. So everything is looking good right now on this one, and a lot of running room. I mean, as you can see from that table, they have well over 100 identified drilling locations, development drilling locations up there in that southeast Saskatchewan asset area. So anyway, hey, thanks guys for hosting this. And
Yeah, thanks, Dan.
yeah, when you're ready, when in the middle of winter you want to get out of Calgary and come down, we have moved our. No, you went to the new place. So our last luncheon we had 45 people, so it's starting to pick up attendance again. Obviously, $90 oil definitely helps our membership. So
That was a really good group of people in that room that we met. That was a great luncheon, one of the best we've ever done. A lot of really informed people there.
yeah.
And we hit minus 20 degrees Celsius somewhere January, February. We would love to come down there for a visit.
Well, yeah, you don't want to come down when the Canadians come down in the summer. We've had like 8 weeks straight where we had triple digit. It's finally cooled off to 95. So here we are at the end of September and it's 95 degrees Fahrenheit. So anyway, terrible. All right, guys, thanks a lot. Sabrina, you can end it there. And thanks everybody for attending.